So we're going to start portfolio management. And this should be your first, this is the first reading in portfolio management. It's called Portfolio Management and Overview. As usual, I teach with the curriculum. So if you have the curriculum with you, you can follow, or you can follow the screen. So just to sort of hold on. Okay. I think it's the maximum I can do. Yeah, so what's this reading about? This reading is about portfolio management. Like I always tell people, the whole essence of CFA is to teach you, focuses on portfolio management, teaches you how to be an efficient portfolio manager. So in your level 1, there's portfolio management. In your level 2, there's portfolio management. And in your level 3, everything is portfolio management. Sorry, please hold on. So, as I was saying, in your level 1 portfolio management, level 2 portfolio management, and level 3, everything about level 3 is portfolio management. So what is portfolio management? This gives us like an introduction into portfolio management and what portfolio management entails and what portfolio management is trying to achieve. Yeah. So in the first side of it, it's the first subsection of this reading is portfolio perspective, diversification, and risk management. Yeah. So what is portfolio management? Portfolio management just focuses on the fact that in order for you to sort of grow your wealth, you need to think about investing in various investments. Yeah. Spreading your wealth across various investments, not just putting only your wealth in only one investment. And the reason why is that if you invest in only one investment, there's a possibility that if that investment goes bad, you will lose a significant chunk of your wealth, or you might end up even getting broke. But when you spread your wealth across various investments, all those investments can't go bad. Please, admin, try and mute your mic, please. Please try and stay muted, because the moment you on mic, you start to interfere. So, as I was saying, when you spread your wealth across various investments, you afford yourself avoiding a situation where all your wealth would dissipate at the same time, because all these investments can't go bad at the same time. Yeah, some might go bad at the same time, some might go bad at different times, so that providing some sort of a balance to your wealth across time. And that's the whole essence of portfolio management. So portfolio management preaches diversification. So that whole idea of spreading your wealth across different investments is what we call diversification. Yeah. And the whole essence is to reduce risk. So the risk that you face if all your wealth is in one investment will be significantly reduced if all your wealth are spread across different investments. A, B, C, D can't go bad at the same time. Yeah, but we've seen situations like the financial crisis of 2008 and the COVID period of 2020 where everything just went bad. So such situations would arise, yeah, but on a general scale, not all investments would sort of be impacted negatively at the same time. So a typical example that we have in the curriculum that speaks more about or touches on this whole concept of portfolio diversification, it's a story about a company called Enron and their employees in the 1990s and early 2000s. if anybody knows the story of Enron, Enron was an organization that was that ran into bankruptcy as a result of financial misconduct. Yeah, but it's not even about the company; it's about the employees of the company. Yeah, who were sort of investing all their savings or using all their savings to buy the shares of Enron. Everybody always feel very, very comfortable that they know about all the activities that is going on in their organization and feel some sort of believe or have some certain level of trust that the organization is sort of in doing the right things. You really don't know, yeah, until the shit hits the fan. So anyway, for them, they were investing their savings in. As I was saying, so the Enron share employees used their savings from their job to buy shares of Enron, and interestingly, their pensions were also used to sort of buy Enron shares. So basically, their whole life, in terms of income, in terms of savings, in terms of investments, in terms of pensions, were all tied to Enron. And the moment Enron collapsed in 2003, they all lost their wealth, lost their income, lost their savings, lost their pensions, lost everything, such that almost all of them committed suicide shortly after the company went down. So the curriculum was just trying to pass how bad it is for you to sort of put entirely all your eggs in in one investment. So a typical example here that we have here is a typical individual was Roger Bruce, a 67-year-old Enron retiree who held all of his $2 million in retirement funds in Enron shares. Between January 2021 and January 2022, Enron shares fell from $90 per share to zero, meaning that guy literally in 1 year lost all his $2 million. It is what to commit suicide. Anyway, so like I had mentioned, the whole essence of portfolio management is reducing risk. Yeah. If you think about it logically, if you make 10 investments, yeah, that all the 10 investments are going to go bad at the same time. So that's the whole idea. Versus if you invest in one, yeah, and that one goes bad. Yeah. So the whole idea is really reducing risk. Portfolio management is not to eliminate risk. Please, it is to reduce risk. Yeah. And one measure that we use to sort of determine that risk reduction capacity of having a portfolio is, sorry, please, guys, hold on a minute, please. I want to quickly do something. Sorry. One of these, what's that word? One of the measures that we use to check this diversification property is what we call diversification risk. Yeah. So diversification risk is, so imagine you have a portfolio Z that has A, B, C, and D shares in them. So portfolio Z has 4 stocks in it or 4 investments in it. And interestingly, one measure, what we use to measure risk in the investment world is what we call standard deviation. So this is designed for standard deviation. So as an instrument, we can determine the standard deviation of Z as itself. Yeah. And we can determine the standard deviation of A, the standard deviation of B, the standard deviation of C, the standard deviation of D. So what we're saying here is you can determine the risk of the portfolio in itself, called portfolio risk. And you can determine the risk of the individual securities or investments in that portfolio, which is what we have here. So diversification ratio, which is DR, is equals to the standard deviation of Z which is the portfolio risk, divided by the risk of any randomly selected investment in that portfolio. So let's just imagine that we randomly select A. So your diversification risk is the standard deviation or the risk of the portfolio divided by the risk of A, which is an investment in the portfolio. Yeah. Your diversification ratio is always less than 1, with the assumption that for you to have created a portfolio Z, the risk of Z will always be less than the risk of any randomly selected security in that portfolio. If your diversification ratio is not 1, then you have not created a portfolio. All you have just done is you have packed things into your portfolio that are technically similar. It's like you saying you bought orange, lime. You said you want to create a portfolio of fruits, and you buy orange, lime, lemon, and grape. Your risk might not necessarily be less than 1 because all these guys are almost the same thing. Yeah, they are all citruses. Yeah. However, if I want to create a portfolio, I will buy orange, banana, watermelon, and let's say soursop. Yeah, they are all basically not the same kind of fruits. With that, there's a very big tendency that the risk of this guy will be less than the risk of each one of them. Yeah. So your diversification ratio is always less than 1, assuming that the risk of the portfolio is less than the risk of any randomly selected instrument. Now, let us now understand what diversification ratio means. Diversification ratio means that a portfolio manager has been able to reduce his risk. So let's just say the diversification ratio, for instance, your diversification ratio here is 0.6 or 60%. Yeah. Now, what the diversification ratio now explains is that the portfolio manager has been able to reduce the risk of the wealth by 40%. You guys understand how I got 40%? 40% here now is 1 minus 600 minus 60%, or 1 minus 0.6, which is 0.4. So I've been able to reduce my risk by 40% as a result of investing in portfolio Z against investing in portfolio A. Let me say that again. If my diversification ratio is 60%, or 0.6, what it means is that I have been able to reduce the risk of my wealth by 40% as a result of investing in portfolio Z against investing in portfolio A. That is how you explain diversification ratio. Yeah. And remember, the diversification ratio, its objective is to measure what? Your ability to reduce risk by creating a portfolio. Yeah. So moving on. Now, there's something we always say, that in portfolio management does not necessarily reduce downside protection. Now, what do we mean by it doesn't necessarily reduce that downside protection? What we're saying there is that don't feel that because you have created a portfolio, you should go to sleep. Don't feel that because I have come here to say that portfolio reduces your risk does not mean that one day your portfolio, or that doesn't mean that your portfolio is foolproof, or one day you can't wake up and all your investment has gone off, which is why I said, remember the times of the financial crisis of 2008 and the COVID period of 2022. No matter what you invested in these two periods, you would have lost significant portion of your wealth. So portfolio management is not risk proof. It doesn't mean that things cannot happen. Yeah. Now, another thing again about portfolio management, a lot of content here to back up everything that I've said. Another thing again about portfolio management that I always like to emphasize is that it is not just buying different, which is what I've mentioned. Your portfolio Z has A, B, C, and D in it. It is not just buying more investments that matters. It is not just buying more than one that matters. It is about what you invest in portfolio Z, meaning that ensuring that the assets or the investments that you make are not similar investments. So a typical example is if I say I want to create a diversified equity portfolio, yeah, equity investment. If I buy Zenith, buy GTB, buy First Bank, and buy, let's say, UBA, I have technically bought the same kind of securities or I've made the same kind of investment. So basically, there's a possibility that the risk of this portfolio might not necessarily be less than the risk of the individual guys. So it is what you invest in that matters, that drives this risk reduction that we're talking about. You must buy investments that are not technically similar. So I can buy Zenith, I can buy Nigerian breweries, I can buy Dangote cement, and I can go and buy, let's say, I can buy Julius Becker. Yeah, they are all basically different types of, so this is the banking industry, this is beverages, this is cement, this is construction. They are all affected by different aspects. But if the whole Nigerian market goes bust, that's what we're trying to say. There's no way you're going to run. All of them are going to go bad. Okay, so moving lastly to what brought about the whole idea of the modern portfolio theory, or rather, what brought about the idea of portfolio management that we speak about today. It's a concept of the modern portfolio theory, which was created by a man or found by a man called Harry Markowitz. So Harry Markowitz is the father of portfolio management. And one emphasis that you would see in his write-up on the modern portfolio theory is the importance of a concept called correlation. Yeah, correlation. It's a concept called correlation, where correlation talks about the relationship that exists, which is what I've mentioned here. It talks about the relationship that exists amongst these four instruments. If the relationship within them is positive, strongly positive, then it doesn't make sense because they will not achieve that the diversification effects that you want. So basically, what you need to do is to look for investments that have low correlations, that have low relationships amongst themselves. And that's the whole idea of what the modern portfolio theory. And the fact that this came to light brought about what we are teaching you today, which is portfolio management. So that is the end of the first part of this reading. Now, moving on to the second part of this reading, we have steps in the portfolio management process. So I always tell people that portfolio management is a process. It's a continuous process. It's a chain. It never stops. It's not like you making painting a picture where you look at what you want to paint, you paint, and you deliver it to whoever wants it. No, it's a continuous process. We keep managing. I always relate portfolio management to growing yam. Yeah, whoever has done agriculture will know that one of the difficult things of planting and growing yam is how do you take care of the stem. So I can remember when I was in secondary school, it was one aspect that intrigued me about farming. Yeah, because you have to have sticks, and at every point in time you have to monitor how the stem is growing on the sticks. If not, the yam will not grow properly. So in the portfolio management process, there are 3 steps. The first step is called the planning step. The second step is called the execution step, while the last step is called the feedback step. Yeah. Please remember that this is a sequence. It must always follow this sequence: planning, execution, and feedback. Now, I'm going to speak about the activities that you would engage in each of these steps. Yeah, which is what the curriculum have put here for us. So under the planning step, the major thing about the planning step is the foundation of your portfolio management. If you get your planning stage wrong, you are going to run into muddy waters. most especially with your clients, most especially with yourself, because you're going to get frustrated, and most especially with achieving your client's objective. It is at the planning step that everything that we are going to build on is formulated. Yeah. So, which is why the first thing you do when you want to start a portfolio management arrangement with your client is to understand that client, understand that client's needs. If you do not understand that client's need, then you're going to run into muddy waters. What does my client want? What are the peculiarities about my client? How often does my client need money? Yeah. What is my client time horizon? Yeah. How long does my client want to invest this money for? What does my client want to achieve with giving me this money? Yeah. It is one thing for somebody to give you 10 billion naira and tell you that they want it this way, and you don't. I realize that is what they want. You go and do something else, and you find yourself in muddy waters. So the first thing you do under the planning step is understanding your client needs. Then once you are done with understanding your client needs, you prepare and execute something we call an investment policy statement. Yeah. So an investment policy statement is a document that contains everything that you understand about your client and what you as a portfolio manager want to achieve for this client. That's what you have in your IPS. It's called an investment policy statement, and for short, in the industry, we just call it IPS. So once you have your investment policy statement, then you have created the foundation. So what I always tell my colleagues is that if I want to understand or appraise your portfolio, all I need to do is ask for the IPS. By the time I read the IPS and I look at the portfolio that you're managing, I will know there and there if you are doing the right thing or not. Yeah, because everything is in the IPS. Everything that you do must be guided by the IPS. Now, once you are done with the planning step, you move to the second step, which is the execution step. Now, under the execution step, you have the asset allocation, security analysis, and portfolio construction. Now, remember that when you are investing, there are different places you can invest. Yeah, you have equities, you have bonds, you have money market instruments, you have real estate, you have commodities spread across the whole place. Yeah. Now, what we do in asset allocation is we determine where, given information that we have in the IPS, we determine which of this, we call them asset classes, which of these asset classes suits or aligns with the client's objective. That's what we do under asset allocation. So it's a decision-making thing, yeah? And once we identify those asset classes, we also ask ourselves the next question to say, based on these asset classes that we have been able to identify, how do we allocate the client's wealth in order for us to be able to achieve this stated or identified objective? And that's what we do under asset allocation. Yeah. Now, let's use for example, imagine if my client wants to invest in equities, stocks. There are 1,000,001 stocks that the client can invest in. Yeah. Meaning, if you look at it on a global perspective, there are a lot. There are almost close to 5,000 stocks in America. There are thousands of stocks in UK. So we're saying, given the available stocks that we have, the available shares that we have, the available equities that do that security analysis. I like to call it security selection and analysis. Yeah. So a typical example is if you have several bonds, which of these bonds are they investing in? In Nigeria, there are different bonds that you can invest in. Which of these bonds do you want to offer to your clients and why? Then you now have the last bit of it, which is portfolio construction. So portfolio construction is after you have identified what asset classes, after you have determined which securities within those asset classes, you now do your actual portfolio construction. That is when you put money to back what you have said you want to do. That is when you call your brokers, you call your counterparties and tell them, this is what I want to do. Take this money and let's hit the road. Yeah. So this at this point is when you now really have those investments that you have said investing. So at this point, you have the actual portfolio. However, it doesn't end there. We now move to the last step, which is the feedback step. And it is at the feedback step where we do portfolio monitoring, rebalancing. Sorry, please hold on, please. So I said, after you have planned, output of planning, input of planning. Let's think about it. The input of the planning stage is understanding your client needs. The output is IPS. For the execution step, inputs are asset allocation and security selection analysis. And your output is the portfolio that you have constructed. Yeah. Then we now move to the last step, which is the feedback step, where you have portfolio monitoring and rebalancing and performance measurement. Now, like I mentioned, portfolio management is not an art. It's a science. It's a process. Yeah. You have where you start and you don't have where you end, because you have to keep monitoring the portfolio. Portfolio dynamics change as time passes. So you need to continue to monitor to ensure that the portfolio at the end of the client's investment horizon meets that client's objective. So at the beginning, you might have felt that the portfolio has met that objective, but as you move along, you realize that it's deviating from that objective. So what do you need to do? You need to monitor to be able to identify those deviations, and you need to rebalance, meaning you need to correct those deviations, meaning take the portfolio back to achieving that objective. So that's what happens under portfolio monitoring and rebalancing. Then portfolio measurement and reporting is at the end of every period, probably most likely quarterly, you need to send a report to your clients to make your clients understand how you are performing as regards achieving his objective. So that's where your performance measurement comes into play. So you have to measure your portfolio, compare it to what the objective is, or try to communicate how it's meeting your client's objective. And lastly is the reporting side of things, which is what we all know as reporting. You have to communicate what you have measured to your clients. So those are the 3 steps of the portfolio management process. Do you have any questions at this point? Or I can keep going? No questions? Any questions? Okay. So moving to the next subsection of this reading, we have types of investors. And now, why did the curriculum talk about types of investors? We're all portfolio managers, and the whole essence is for us to be able to know our target market. Who are the people that we will be selling our product, our services to? Yeah. So we have 2 categories, and I like to tell people that you have 2 categories. You have the individuals. Yeah. You have the individuals and you have the institutions. Now, for the individuals, it is a bit quite problematic. And I'll tell you why I say quite problematic. Problematic because, let's use for instance, we have T.O., Sam, Bolaji on this call. 3 of you can come to me now with, let's say, 1 billion naira each. Yeah, and tell me that you want me to manage this 1 billion. There's a very big possibility that the 3 of you will not have the same objective. While T.O. might be looking at a case where he wants the money to stay the test of time, such that he wants intergenerational wealth transfer, where this money would adequately touch his 4th generation conveniently. Yeah, so that's T.O.'s objective. Another one might be, Sam might say the reason why he wants 1 billion saved is in, say, 5 years time or 10 years time, he wants to go into politics and he wants to ensure that he has adequate funds in order for him to cater for his political affairs. That is Sam. Bolaji can come and say the reason why he's giving me money is because in 5 years time he wants to build one of the biggest residential edifice in Ikoyi. He wants people to be passing his house and be saying, wow. Different reasons, that's the issue with individual investors. So the more individual investors you have, the more problematic or challenging portfolio management can be. Yeah. But the curriculum speaks highly of a particular plan, which is the defined contributory pension plan. Yeah. And the reason why the curriculum talks about these DC plans, they are called for short DC plans, is because in America, yeah, anybody that subscribes to a DC plan automatically is a potential individual client. Why? So the way the DC plan works in America is that at the end of every month, they pay your pensions. So your pension is included in your salary if you subscribe to this plan, such that that salary, that portion of your salary that is catered to pension, the expectation is that you should invest it against spending it. Though some people would, sort of spend it, yeah. But the whole idea is that you invest it, and that's what brought about something we call the 401k plan. Because the 401k plan is like that product that has been created by most practitioners, investment practitioners in America, to cater for, to meet that, to take in those pensions from these individuals. So technically, what they're saying is, you can target for individual clients, you can target subscribers of this plan and see how you can turn them to your clients. But like I mentioned, the challenge is that most of them, all your individual clients, would not have the same objectives, so which makes it more difficult to manage. However, coming into the institutional investor space, we've been able to break or bucket institutional clients or put institutional clients into different buckets. Yeah. And the reason why is that as long as you have the characteristics of such an institution, your objective would be the same. Yeah. So a typical example I always tell people is a bank is a bank. No matter how you do it, the same objective of a bank, the banks have the same objective. Yeah. And the objective is very simple. I need to be able to make more money from the deposit that I have. So the deposits are the liabilities. So whatever I offer people as deposits, I must be able to earn more from that money when the money comes to me. So I must earn more returns. I must earn higher returns than what I offer people in rates. Yeah. So objectives are the same. As long as you call yourself a bank, that objective is paramount. That's your number one or your primary objective. So the first institutional investor are defined benefit pension plans. You can see that this is the opposite of defined contributory pension plan. Yeah. So the defined benefit pension plan are those pension plans that our parents and grandparents used to have back in the days, where the company sets aside, I'll make provisions for your retirement, such that if you retire in that organization, the company will be paying you your pension up until death. So they'll be paying an amount up until death. That's the defined benefit pension plan. So any organization that still runs this type, automatically your target client. Yeah, you ensure that at retirement they can sufficiently pay whoever enters their retirement pool. Yeah, so that's defined benefit pension plan. The next guys are endowments and foundations. For the interest of time, I always try to play a game here, but I will not because of time. Yeah. So endowments are funds from non-profit institutions. So let me explain. Yeah, they have these two are different entities, but they have the same. Yeah, they have the same objectives. So what is an endowment? An endowment is, I'll call it an account. An account that a non-profit institution, meaning that institutions that are created not for profit, e.g., tertiary institutions, universities, schools, and all that, that are not necessarily meant for profit. Yeah, create an account where they get donations from the public. Yeah, they get donations from the public, and the whole essence is the donations that they get, they use the funds to support their day-to-day activity. Yeah, so those are endowments, while foundations are the actual non-profit organizations that have been set up in order to achieve or tackle a certain objectives. In order for them to run, they receive donations sort of align with that objective that they want to sort of want to cater. So a typical example is the Lagos State Security Trust Fund. Yeah, even though it's called the trust fund, it's a non-profit organization, and the whole essence of that organization is to support security in Lagos State. So anybody that aligns with that objective of supporting and increasing the security you have in Lagos State will sort of donate to the non-profit organization so that they can meet their objectives. So there are two different things. This is an account that is owned by a non-profit organization, while because this account is different from the non-profit organization. They are separate entities, but is owned by the non-profit. But for a foundation, the foundation itself is the non-profit organization. Yeah. They manage their money, their investment objectives are the same. Why? Because the whole essence of receiving these donations is to manage these donations in such a way that they generate income that sufficiently supports their day-to-day activities. Yeah. Without those donations, they won't exist. So more dependent on the donations is the foundation. So for the foundation, without the donations, it doesn't exist. But for the endowment, the institution that owns the endowment can still function because it's probably getting funds or operational funds for somewhere else. The whole essence of the endowment is to sort of enhance the operational running. Yeah. So yeah, so they are both the same thing. They manage their money in order for them to sort of generate income that would support their business. Yeah. Okay. So moving on, we have talked about three institutional investors now. Let's move to the fourth. The fourth one are banks, which I've mentioned before. The primary objective of the bank is to earn money that is higher than what they offer on deposits, so that that spread is what goes to them. And because because the depositors' money are short term, yeah, investment liquidity is a key factor for banks. That's why you see here liquidity is a key factor. We need to consider liquidity. Yeah, so liquidity of funds is paramount, is more important than return that you generate on the funds. Yeah, if you understand Yoruba. Now, insurance companies are also part of your clients. What do insurance companies do? They buy your risk. So you pay them they don't buy your risk. Apologies. They, what's that word? They take your risk off you. So you pay them to take your risk off you. That's what insurance companies do. And what you pay them are called premiums. So insurance companies work with the concept of large numbers, which is if I can get a lot of people to subscribe for this insurance and they pay me a premium, and I pray that none of them come for these premiums, automatically the premiums become mine. However, if one or two people come for claims, meaning that these risks that we have taken off them, we need to make them whole. And the only way we can make them whole is from the premiums that we have collected. So most insurance companies will pray that nobody comes to collect claims. But the whole essence of their job is to ensure that when people come and collect claims, they can what? Be made whole. Now, while the premium is with the premiums have been received from the investors, and the insurance company is waiting for subscribers, the insured to come for their money, the premiums need to be invested. Yeah, it needs to be invested. It would not make sense if all the money just sit at one place and nothing happens to those money, they don't grow. Then fast forward 5 months or 6 months down the line, or 1 year down the line, the risk crystallizes and significant risk come, and the companies have to pay premiums and the premiums have not grown. Yeah. However, in the insurance space, we have two types of insurance. We have life insurance and non-life. Yeah. Life insurance are the guys that go for long-term endowment life insurance. I have money I've given you. You guys must have watched a lot of American movies where they will tell you that the wife killed the husband because of the insurance. Yeah. So that's life insurance. So which is I have paid a significant money such that upon my death, my stated beneficiaries will get compensated. Yeah. When someone else that you have such, you become a target. Considering the fact that they know that you have put them as beneficiaries, they'll be looking out to kill you. But that's American, but that's just a by comment. But you guys get the whole idea of insurance. Yeah. Now, the next are sovereign wealth funds. Yeah. Sovereign wealth funds are the savings of nations. So like Nigeria has a sovereign wealth fund that was brought to life by President Goodluck Jonathan. He started it with $1 billion, and fast forward today, I'm sure that money has grown in magnitude, and that's what a lot of countries are doing now. I believe the biggest sovereign wealth fund probably might be China or Saudi Arabia. It's between China, Saudi Arabia, and Norway. It would be a good one to check because I had a class. Apologies, let me just check. Largest sovereign wealth fund in the world. 2024. So let's do 2020. Okay, 2024. Let's see. Yeah. I like which United States. United States, which United States has the largest? Okay, you guys kidding me? Anyway, let's move on. That's something that we can check on our own. So just moving on to where we were. So sovereign wealth fund are also your clients. As at this time, this is 2018. Norway had the largest, but I'm sure things might have changed. Guys like China and Abu Dhabi and Saudi Arabia, they've been on a hot chase. So I'm sure that would have changed. So yeah, so as long as you are engaging a sovereign wealth fund, their objective are the same. Yeah, wealth growth over a long term. Yeah, so that over so many years, when the country is in some like maybe dire need of money, the sovereign wealth fund can sort of step in. Yeah. Now, just moving on. So I like this table, and I like to tell people to sort of take in this table and memorize it. it's a good one, and this is a table that you can see a lot of questions from at your exam. It goes all the way down to sovereign wealth funds. And what this table just does is it categorizes your clients according to their investment horizon, their risk tolerance, their income needs, and their liquidity needs. Yeah. So, and their liquidity needs. So, in terms of, so what is time horizon? Let's explain what each one of them are. So what is time horizon? Time horizon is the length of time that it takes, that the average time, the average length of time that they ordinarily invest. Yeah, the average length of time. So like a typical example is endowment. Remember I told you very long. Yeah, why is it very long? Very long because the donations that they have is what supports their operations. And there's no organization that doesn't want to exist for a very long time. So if I can manage that money such that it can adequately support my operational activities for a very long time, then I would jump, I would want that. So which is why the average length of time for investing is always long term, very long term. For banks, it's short, yeah, which is what I mentioned. The money that the bank has to invest is from depositors' funds. And depositors' funds is short term. Why? I can put money in a bank today and tomorrow I want the money. Yeah. So depositors' funds is short term. So as a result of that, your investment should also be done what? Short term. Now, let's move to risk tolerance. What do we mean by risk tolerance? Risk tolerance is the amount of risk that you want to assume, the amount of risk that you want to take in order to meet your objectives. And your risk tolerance are driven by two things. One, your willingness to take risk, and your ability to take risk. Don't worry, we'll talk about that in another reading, but just think about it that your risk tolerance is the amount of risk that you want to take in order for you to achieve your objectives. Yeah. So your risk tolerance can either be low or high. Meaning, if my risk tolerance is high, then it means that I want to take risk. If my risk tolerance is low, then it means that I don't want to take risk. Money must not lose. So a typical example is banks. Their risk tolerance is very low because money must not lose. There's nobody here that will deposit their money with any bank, and they want to take their money from the bank, and the bank tells them that we are sorry, your money has lost. So we went to make one investment and the money did not come back. Yeah. So risk tolerance is what? Is low. And if you can remember the story of the Silicon Valley Bank, that would sort of give you a good picture of what happens with banking and their investments. These are compared to endowments, they can take risk. Yeah, they can take risk because they look at long term. Yeah. It's just a small portion of their money that they need, which can be generated by income, by a small portion of their income. Yeah. So technically, they can take risk. So one thing I want you to look at is the relationship between time horizon and risk tolerance, which is positive. So if your time horizon is long, then your risk tolerance is high. So there's a positive relationship between time horizon and risk tolerance. So you can see short-term horizon, low risk tolerance. So you can see that there's a positive relationship. Yeah. Now, what are income needs? Income needs just talks about the sort of income that they need from these investments. Yeah. Which is why I remember what I said for endowment, they just want to meet spending commitments. While for banks, they want to ensure that they can pay their interest and pay their clients money back. Yeah. So those are the income needs. But let's focus on liquidity. And I can always tell people there's a difference between income and liquidity. Income means the cash that is generated from the asset, while liquidity means how quickly can you turn this asset to what? To cash. How quickly can you turn it to cash? Yeah. So another thing again I want you to think about is the relationship between liquidity needs and time horizon. Yeah. If your time horizon is long, then your liquidity need is low. You really don't need liquidity that you can invest in securities that are not liquid. While if your time horizon is short, your liquidity needs to be high because you need to be able to convert that money back to cash because people would need their money very fast or in a short period. So you don't want to invest in an illiquid investment that after 3 months, the person wants their money and you are stuck. So you need to think about the liquidity of this instrument. So high liquidity. So what I want to now tell you now is there's a negative relationship between time horizon and liquidity needs. Short-term horizon, high liquidity needs. Long-term horizon, low liquidity needs. So there's an inverse relationship between that and that. So by the time you look at the others, I'm sure you would see the consistency in that relationship. Now, with these few points, can I request that we take a 10 minutes break? So we come back at 2:50. 10 minutes break. We have only 2 sections left, and I feel we can wrap up these 2 sessions within the next 1 hour. So let's take a 10 minutes. 10 minutes. Okay, I'm back. Okay, so moving on with everything that we've said, let's speak a bit about the asset management industry. Yeah. So what the curriculum is just trying to achieve is to give us a better understanding of that industry. So the portfolio managers are technically the guys that make up that industry, the asset management industry. So you have an asset management business. You offer portfolio management services to your clients. You've been able to target all these clients. So what's this industry about? So they spoke about some different things. One thing is I love to mention all the time. And I see that happening a lot. Yeah. An asset manager is commonly referred to as a buy-side firm. Yeah. So I like to do this a lot. The investment management space is divided into 2 parts. We have the buy side and we have the sell side. Yeah. Let's start with the sell side. The sell side are predominantly investment bankers. So when you hear I'm an investment banker, what that means is you are in the sell side of the investment space. Yeah. And what do investment bankers do? They are the guys that engage companies. Yeah. They engage companies to help companies raise capital for their projects or for their needs. So they help companies to raise capital. And companies can only raise capital using either equity issuances or fixed income, that's debt, or any other type of securities. So basically, an investment bank, as the name refers, are sellers of securities. Yeah. So an investment banker is a seller of securities. Now, who do these investment banks sell these securities to? They sell these securities to the buy side guys. And the buy side guys are the investment managers, are the portfolio managers. The guys, what do portfolio managers do, which is everything that I've been talking about now, is they reach out to the people that have money and tell these guys that they want to help them to manage that money because of their ability to be able to what? Remember security selection, their ability, remember asset allocation. This is asset allocation that I've talked about here. This is security selection that I've talked about here. So these guys, investment bankers, can either choose any asset class and issue securities on behalf of their companies to help their companies raise what? Capital. Now, me, I am a portfolio manager. What am I telling my clients? Bring your money. Let me help you grow your wealth by identifying which asset classes and which securities you should invest in. So this is the buy side guy, and the buy side is what we have been teaching, and we are going to be teaching you guys how to become buy side managers, how to become portfolio managers, how to exist in the buy side of things, of the buy side of the investment space. Yeah. So as they said, a sell side firm is a broker or a dealer that sells securities and provide independent investment research and recommendation to their clients. So anybody that you see that is hawking securities, that is telling you, come and help us, come and buy now, come and invest now, come and invest in this security, most likely he is a sell side guy. Now, another aspect of the industry that has sort of cropped up a lot is the distinction between active portfolio management and passive portfolio management. So what is active? Yeah, active is where you sort of have. So let me explain. Let me start from here. In the world of portfolio management, which you are going to hear, yeah, in achieving portfolio, something we call benchmark. So is this benchmark that we use to sort of gauge our performance? Yeah, because this benchmark technically aligns with your client's objective. Yeah, so it aligns with your client's objective. So at every point in time, we are looking at what we are doing versus this benchmark. So if your performance of your portfolio is less than this benchmark, then it means that you're not meeting your client's objective. Most times, active management emphasizes on the fact that I have the ability as a portfolio manager to beat benchmarks. So tell me what the benchmark is. I have been able to create a methodology that I would use to beat that benchmark. That is active portfolio management. While passive portfolio management is just saying, you know what, I don't want to beat the benchmark. I just want to deliver the benchmark to you. I don't have any skill. I don't want to do any over skill or show anything. Just tell me what the benchmark is. I have created a methodology that I would use to achieve this your benchmark. So I give you what you want, and everybody's happy and everybody goes home. Yeah. Over the years, a lot of portfolio managers have portrayed themselves as active portfolio managers. Give me the benchmark and I'm going to beat it. And the reason why is that as an active portfolio manager, you are putting yourself in a position to do what? To be able to charge more fees. Yeah. Don't worry, we'll talk about fees later. Yeah. Charge more fees. While versus a passive portfolio manager. So it's like you saying, you come to me now and you're telling me I should give you a Benz 230. And I'm telling you that I can even give you a V-boot. If you know cars very well, yeah, I can give you a V-boot. Why settle for a Benz 230? The moment you tell me yes, it gives me room to bill you more because I'm giving you a better car. Versus somebody that comes and says, I want a Benz 230, and I say, no problem, take your Benz 230 and go. I'm going to give you a Benz 230. Your ability to price at that point is to charge fees at that point is lesser. But anyway, over the years, we have realized that portfolio management, passive portfolio management has been gaining the ground because year after year, we realize that the ability to beat benchmarks is getting more difficult as we move along in time. Yeah, so passive portfolio management has grown significantly over the years. Now, another aspect is traditional versus alternative. Yeah, so traditional assets. When you talk about, before you can talk about traditional asset managers, let's even talk about traditional assets. So traditional assets are the equities and the bonds, the equities and fixed income. Yeah, EI and FI are the traditional. EI and FI are the traditional investment outlets. Yeah. While alternative investment has been gaining the ground, e.g., real estate. Another one is commodities. Another one is hedge funds. So everything you are going to learn under alternative investment comes into alternative assets. Yeah. these guys have been gaining grounds over the years because people have continued to seek for other investment opportunities beyond equities and stocks. There should be more. So you can come here and you can even put Bitcoin for the guys that like BTC. So you can put Bitcoin under alternative asset classes. Yeah. Then you have what? The one that's been gaining a lot of ground here is what? Arts. Yeah. So the buying and selling of arts. It's also part of alternative investments. So that's been gaining grounds over the years. Now let's move to ownership structure. Yeah. Most asset management firms are like private companies that have shareholders and all that. And the key personnel are the portfolio manager. So the portfolio manager seems to be like the important case. Yeah. But I have come to a realization of recent times that your business development is also key. Your business development team is more important than your portfolio. Not necessarily more important, but more important by your portfolio manager. Because these are the guys that bring in the money. And if there's no money coming in, there's nothing that the portfolio manager is going to do. Portfolio manager is not going to cook. He's not going to make money out of what? Out of air. So business development is more important. But a lot of people get it wrong. They give more prevalence to portfolio managers. Yeah. Okay. But yes, it's like a symbiotic relationship because if the money comes in and you don't have portfolio managers, how would you sort of? But for me, like I always tell people, let the money even first come in first. Managing it will take its own course. Yeah. So, like I mentioned before, what are we seeing in terms of industry trends? We have been seeing passive portfolio management growing significantly over the years. So these are the guys that are the major passive portfolio managers that we have currently. So these guys are the major guys: iShares, Vanguard, Street Global. Then there's a lot of data, use of big data coming in. Yeah, social media data. So all these are things that we use to understand. Remember that planning step, understanding your client needs. So we've started using data to understand our client needs. Then moving forward, is what we call robo advisors. So we've seen a lot of like I said, tech and all that has come in significantly into so you guys can read on something called wealth tech. Yeah. So wealth tech has sort of come in the way you have fintech. So you have what we call wealth tech. So technology has come into this space over the years. So robo advisors, we're using robo advisors to advise technology to advise our clients now. And all these are led to what? Low fees, new entrants, which is technology guys, after coming in. So those are the aspects of the asset management space that you need to understand. Okay, I don't think this will be testable in your exam, but it's just a good read. Now let's move to the last part of this reading, which is pooled investment. So in Nigeria, we call this collective investment schemes. Yeah, but so it's called pooled. Before it used to be called pooled investments, but now they're calling it pooled interest. Now, what do we mean by pooled interest? Everybody in this class now can come together now and make contribution in order for them to make an investment. So let's imagine we want to buy that building. We want to buy a house. I've seen a house that maybe. So let me give you guys an example. So sometime last 2 years, I stumbled on an opportunity to buy a house in Banana Island in Ikoyi for about 600 million naira. Yeah, the person was selling it, was doing a distress sale, 600 naira. By the time that house was valued, it was valued for billions, or maybe close to like 1.5 billion or 1.2 billion. Yeah, but the challenge is the guy was desperately in need of money, and that opportunity came. I stumbled on that opportunity. Yeah, and the question now is, do I have 600 million? The answer to that is no. But is that a fantastic opportunity? Yes. Even if you don't sell it for 1.2 billion, at least if you sell it for 1 billion, you have made more than half of 50% of what you have invested. So what was the way forward? Gather a lot of partners. Yeah. That's what we call pooled investment. So gather a lot of partners, bring all of them into the room, 10, 20 guys. How far can we raise 600 million? If we're doing it equally, that's 30 million per person. Let's bring all this money together. Let's buy this property and hold it for like say 1 year and sell it off at any price, nothing less than 1 billion. Yeah, that's good investment. Yeah. So that's what we call pooled interest. When several people come together to make an investment, given that they have similar objectives. So that's pooled interest. Now, other pooled interest, we have the most prominent one, which is mutual funds. So I'm sure you guys must know, you guys must have heard of mutual funds. There are mutual funds in Nigeria. Currently in the investment management space in Nigeria, mutual funds seems to be like the most prominent investment vehicle. Yeah. So like they said, a mutual fund is a type, this type of fund is a commingled investment pool in which investors in the fund each have a pro rata claim on the income and the value of the fund. So we all put money together, separate amounts, it doesn't have to be equal, such that whatever income comes to that is made on that investment, we share it in line with what we contributed. And if that investment grows over time and we decide to sell, we are also entitled to getting or sharing that money in line with our contribution. So your contribution to it is very, 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 very important. Yeah. So we have two types of what's that thing called? Two types of mutual funds. We have the closed-end fund and we have the open-end fund. Yeah. So the closed-end fund is a fund that allows for easy entry and exit. Easy entry and exit. Meaning that if you want to, so there's always a portfolio manager. Yeah. So every mutual fund always has an asset management firm that is pushing that mutual fund. Yeah. So the reason why the open end has easy entry and exit is because anybody that wants to enter, they can enter. The portfolio manager, the asset management firm will give them allowance to enter, will take in their funds and give them evidence that they are members of the fund. Yeah. While anytime somebody wants to exit, yeah, the portfolio manager would buy you out. So the portfolio manager also acts as the intermediary or the dealer of the mutual fund. So if you want to enter the mutual fund, the asset manager will take you in. If you want to go, the asset manager will buy you out. You look for funds to buy you out. So every other person now becomes owner of your investment, technically. So that's and majority of funds, mutual funds existing now are open-ended funds. While closed-ended funds, there are no entry and exit. Or rather, it is as the name implies, is closed, meaning that at the beginning of the period, the investors at the beginning will continue to be the investors till the end. It doesn't allow for entry and exit during the period. However, anybody that wants to enter during the period there must be a willing member that wants to exit. So your entry can only be admitted if there's somebody that wants to leave. However, if you want to leave, there must be somebody out there that is interested in coming in. So the fund manager does not act as any dealer or intermediary. It doesn't. The only thing that the fund manager wants to do is manage this fund to the end and give you guys and achieve that objective that he has said he wants to. So if you are looking for money Go and look for money somewhere else. The guy will not answer you. Yeah. So those are the structural differences between an open end and a closed end. And obviously, because of this restriction, we have seen a lot of open end funds have been prevalent. Yeah, it's all right. Now, most of these funds charge what we call fees, and those fees that are being charged is what we call load. So a load is charges. Anyway, yeah, mutual fund load. What should come to your mind are charges. Now, some funds do not charge, while some funds charge. Yeah. So sorry, a load. Sorry, load is called sales charge. Apologies, sales charge. And let me tell you what we mean by sales charge. Sales charge in the sense that if you want to come in, yeah, the fund is going to charge you, and if you want to go out, the fund is going to charge you. So there's what we call it exit and entry charges. Yeah, there are some funds in Nigeria. Most of our mutual funds do not have loads, do not have these charges. Yeah. However, in America, you see it depends. So there are some mutual funds that have charges, there's some mutual funds that don't have charges. So it's called load and no load. Yeah. However, for load, for mutual funds that have loads, we have what we call front end load and back end load. So front end load is what is applicable to what entry. Back end load is what is applicable to what exit. While some charge only one, others charge both, meaning that if you are entering, you get charged. If you are exiting, you get charged. While some can do, entry is only free, exit, you charge. Or some do, when you are entering, you charge, but when you are exiting, you don't charge. So you have to understand the peculiarities of the mutual fund before you invest. Now, moving on to types of mutual funds. We have, so I always tell people that the types of mutual funds is dependent on what the asset class, excuse me, the asset class or the instruments that the mutual fund is focusing on. So predominantly we have mutual fund, money market funds. What does money market fund tell you? These are mutual funds that focus on what? Money market instruments. Nothing more, nothing less. Yeah. If you hear bond mutual funds, what should come to your mind are what? Mutual funds that focuses on what? That primarily invest in what? Bonds. Yeah. While if you hear stock mutual funds or equity mutual funds, these are mutual funds that predominantly invest in what? In stocks or equities. Yeah. So we need to understand that. While we have hybrid or balanced funds, those are the funds that they can focus on more than two types of investment. So typically, predominant one is equity and bonds. Yeah. So when you see a mutual fund that has both equities and bonds in it, then it is a what? It is a balanced fund. Yeah, makes sense. I believe makes sense. Okay, now what does the curriculum do? What the curriculum is now doing is let us look at the differences between mutual funds and the other types of pooled or other types of investment structures or investment products. So a mutual fund is an investment product. Yeah. So what are the differences between mutual funds and other types of investment products? So what did they do here? Number one is what? Separately managed accounts. Now, separately managed accounts are not predominantly investment products. They are more tailored to what? Portfolio management services, where you are managing funds on behalf of a particular client. So you are not pulling investments. The client gives you 1 billion, you manage that 1 billion tailored directly to the client. Yeah, so that is a separately managed account, and they are predominantly different from pooled interest and are for majorly HNIs and large institutions, yeah, that do that separately managed account. For retail or mass affluent, it's always best you go the pooled interest route. Yeah, that's a solution that has been created to the nuances of what investing for what individuals. Just do a mutual fund and move on with your life. Yeah. Okay. So moving on, another type of pooled investment as exchange traded fund. We're going to talk about these guys predominantly in your level 2, but they are very different from mutual funds, and they said that they identified those differences here. Other key differences, okay, sorry, not only that. Let me just tell you what the differences are. So yeah, an ETF trades on an exchange. That is why it's called exchange traded funds. They trade on an exchange like stocks. But mutual funds do not trade on an exchange. Mutual funds are managed by a fund manager or an asset management firm. Yeah. So that's one predominant difference between the both of them. Then structurally, they are different too. Yeah. While the exchange traded funds works with market price, the mutual fund works with something we call net asset value per unit. So there are two different methodology. This guy is determined by demand and supply. This guy is determined by the changes in the prices of what your portfolio manager or investment manager invests in. Yeah, so there are two different things. Yeah. Then lastly is transaction costs. Because this guy is trading on an exchange, if you are investing in it, you are exposing yourself to what we call transaction costs, like brokerage fees, which you can technically say is the same thing as load. But like I mentioned earlier, predominantly most mutual funds do not have this load. Yeah. So those are the differences. In terms of dividends, another thing again is dividends. So the structure to dividends payments are different. While the exchange traded fund would pay you dividends, the dividends paid by the mutual fund is at the discretion of the asset manager or the fund manager. The fund manager might decide not to pay funds, not to pay dividends at a particular point in time, probably due to maybe illiquidity risk or the fact that in order for you to generate cash, you might be significantly putting the portfolio at risk. Beyond that, I think we're fine in terms of differences. Now, moving to hedge funds. Hedge funds are also pooled, but hedge funds are very different from mutual funds. Why? One, hedge funds are private, meaning that you cannot publicize, there's no publicity attached to hedge funds. You cannot market or solicit for, you can solicit for funds, but you cannot solicit for funds from the public. While for mutual funds, you can solicit for funds from the public. Another difference between hedge funds and mutual funds is hedge funds are not regulated. They're not regulated investment vehicles, while mutual funds are regulated. Yeah. Then the next difference between hedge funds and mutual funds are strategy. While hedge funds invest based on strategy, not asset classes, mutual funds invest based on asset classes. So meaning that a hedge fund today can be focusing on equities. The next day, it focuses on FX. The next day, it focuses on what next. It's as long as whatever is investing in aligns with its strategy, paramount strategy. While for mutual funds, you are focusing on a particular asset class. That's the very key difference between hedge funds and what's that word? And mutual funds. Yeah. So regulation, publicity, strategy of investment. Okay. Now, to the then lastly, before I go, hedge funds are for big boys. Are for big boys, very big boys. I'm sure if you know about hedge funds, you know that it's not for mokekere, it's for big boys. Okay, so moving on to the next one, we have what we call private equity and venture capital fund. Yeah, private equity and venture capital funds. Now, these are another set of funds for big boys. However, for these guys, they are predominantly looking for startup companies, which is the venture capital guys, or they are looking for private investments in public companies, or technically private investments in companies. Yeah, so it can either be a private company or a public company, but it's private investments, while venture capital guys invest in startups. And for you to be a member of this club, you have to be a big boy, because the minimum millions of nairas, millions of dollars is required. Yeah. Structure are very different too. The way they charge their fees are different, but they are predominantly very different from mutual funds. They don't even think that they are even pooled investment. The only thing is that they raise capital from several clients or several investors in order for them to achieve their objectives. With this viewpoint of mine, I have come to the end of this reading. Interestingly, this reading did not take me 2 hours. I thought we were going to spend 2 hours in order for us to finish this reading, but we're done with this reading. So, at this junction, I am open to your questions. Considering the fact that everybody has been quiet, I expect that it seems like everything I've been saying has been making sense. So, let me have your questions if you have any questions. And in the absence of any questions, we can call it a fantastic day and round up at this point. So, questions?
Yeah, just one question, please.
Please go ahead.
So when you were talking about the differences between ETFs and mutual funds, um, I needed to repeat the managers. I think you said mutual funds, one is managed by asset management or portfolio managers or something. So I needed to repeat that part.
So I never said anything about managers for ETFs. All I said that for ETFs trade on an exchange, while mutual funds do not trade by exchange. Yeah, they are
Yeah, okay,
managed
yeah.
by asset managers.
Okay, yeah,
Um,
that's
then you now have the prices, because because exchange traded funds trade on an exchange, they are determined by market prices, forces of demand and supply. However, for a mutual fund, the price of a mutual fund is determined by the NAV per unit, which is driven by the prices of the underlying investments that the fund manager has made. Yeah, I think that's predominantly the difference. Is then transaction costs that you incur when you're buying an ETF versus transaction costs that are not there for ETFs and for mutual funds. Yeah, so that's predominantly the differences. Any other question?
no, that's fine. Thank you.
Okay. Any other person with a question? Any other person with questions? Any other question? Okay. In the absence of any other question, I can say I hope I've been able to convince you or not confuse you that portfolio management leads to risk reduction. That you have 3 steps to the portfolio management process. That you have 2 categories of investors. Passive investment has taken over in the last few years in the investment management space, and mutual funds have been created as a solution to the to the complexity of managing individual investors. Thank you very much. And I would hope you can go through what I've taught you today. And at the next class, if you have questions, you can sort of bring up the questions and we'll look at them intensively. Thank you very much and do have a fantastic Sunday.